Hi guys, let's finish off taxation of ESOP. Again, very important. So see guys, you have income from house property and income from salary. That is also part of the syllabus. But then whatever was there in CA Inter, all that allowances, etc. and house property calculation, nothing they'll ask in the exam. What they'll ask is some higher level items. Higher level items like, for example, taxation of employees stock option plan, because this will come under section number 17, which is your perquisite chapter. So under perquisite chapter, particular thing will come. Similarly, taxation on the startups, etc. that will come. So they'll combine this. If you sell your ESOP or if you buy ESOP, what is the taxation for the company? If the person sells that ESOP, whatever he had, what is the taxation for the particular person? All those questions they'll ask. Right? So that salary part comes there. If you remember in income from other sources, we had done clubbing provisions, basically not income provisions, clubbing provisions. You also did a concept called deemed donor. So it will come there. So deemed donor is section 27, which is obviously house property. So those higher elements of classes will come, higher elements of concepts will come in CA final. That basic, LOP, DLOP, all this will not come, guys. They have other things to test you and not those things. So do not worry about all those things. But nevertheless, if you want to brush through the normal salary chapter, HP chapter, I will also upload. You can check a little while later. I will upload an open PDF on higher this thing, house property and salary. You can go. That is, CA Inter stuff you can go through. But CA final student will not have the time to check all those things, because so much is here only to ask. So they will not ask those things. Generally, it has never come, but I will never say salary and expenditure will never come. It will come in terms of this. For example, ESOP is nothing but salary chapter. It is salary chapter, capital gain chapter. Similarly, clubbing of income is a separate chapter along with deemed donor, which is house property. So that's what I'm trying to tell. So let's understand the concept of ESOP. ESOPs are taxable as perquisites in the hands of the employees. Perquisite in the hands of the employee. So if you see section number 17, which talks about what is a perquisite. Let's see. Perquisite. So in this, if you see here, the value of any specified security or sweat equity shares allotted or transferred directly or indirectly by the employer or former employer free of cost or at concessional rate to the SSE. So guys, what is this? Generally, let us say on 1/1/19, you are employed in the company, I work for a couple of years, let's say. So I will offer you 1,000 shares of ESOP. The fair market value of those shares are, let's say, 1,100 rupees. On 1/1/21, they will tell, I will offer you only if you work for 2 years. These 2 years are called as the vesting period. On 1/1/21, you now become eligible to buy the shares. You become eligible to buy the shares, which means vesting has happened, vesting period, eligibility. Here, fair market value, let's say, is 1,200. You will be given a vesting, period, a period where you can exercise the option. You can exercise the option. You will exercise the option, let's say, on 1/7/2021. 5-6 months will be given. You will do it on 1/7/21. Option is exercised. Now FMV is 1,300 rupees. They will immediately not allot in the moment you exercise. They will allot it sometime later. Let's say a few months later, 30th November 21. or let's say next year 22, they will allot. This time FMV will be at 1500. 1000 shares of ESOP, face value 10 rupees. Now guys, tell me, what does the law says? The law says that taxability will arise at the time of allotment. Taxability will be at the time of allotment, but the FMV will be the date when the option is exercised, because that day you decide to buy. Just because the company delays by so long, you cannot hold the person liable for that. So at this price 1300, so 1300 will be the FMV minus what? Face value. It's 10. So 1290. 1290. This will be the value of the perquisite, which is taxable in whose hands? Employee's hands. Right? It's an option given, so this will be taxable in the hands of the employees. So in the previous session, we did taxability and we did ESOP also. That ESOP was what? That was buyback of ESOP. So then obviously it is taxable in the hands of the company. This is not buyback, this is giving ESOP. So when I am giving ESOP, obviously it will be liable in whose hands? It will be liable in the hands of the, what do you say, shareholder. That is the employee. Now many tax planning they used to do. Since this is for an employee, they used to wait for the employment to get over. After that, one day later, they used to issue ESOP or similar something to ESOP or sweat equity. What is sweat equity? That is for the sweat that you have given to the company. The sweat equity is different. Sweat equity is for the consideration already paid. So if you have worked something, if you have given know-how, if you have obviously worked hard in the company, then that is ESOP. So one of my dad's friends, he joined Infosys, true story, in the year 1986. In the year 1986, just when Infosys was forming, at the formation only he started. 1982, sorry, Infosys came. So 1986 he joined. He worked for 14 years in the company, 1986 to 2000. He was the person to construct all these, civil engineering work. All campuses were under his guidance. In 2000, Narayan Murthy went to MCA and went to the ministry and said, I want to, there is a section in, Companies Act. True story this is. This is how this entire section came about. There was a section 53 which said, any share issued by a company at a discount shall be void. Narayan Murthy went to MCA and said, sir, I want to give free shares to my employees. MCA said, not possible, sir. He said, why the hell? He said, no, sir, not possible because this is section. He said, boss, employees have given their blood and sweat for the company. He named the term actually, sweat equity. They have given their blood to the company. You need to allow me to do that. Based on strong recommendations in the Companies Amendment Act 2000, same year, section 54. I mean, that was old law, 1956 law. A different section was there. Sweat equity shares was inserted. See, 79A was inserted. 79, 80 were there. 79A was inserted in 2000, 1956 Act. Right? Yes, you are notwithstanding anything contained in 53. What is 53? You cannot issue shares at a discount. Here it says, yes, may issue sweat equity shares if this procedure is followed. And you see section 53 also, there they have said, except as provided in 54, company shall not issue shares at a discount. Wonderful. So my dad's friend, Narayan Murthy called my dad's friend and he handed over a check for sweat equity shares. That time in the year 2000, 24, 25 years ago, 23 years ago, that was valued at, believe it or not, 2 crore rupees. 23 years ago, 2 crore. He said, sir, from tomorrow I'm quitting. He said, no problem. Your wish. Please go spend time with your family because 14 years you have given your life, your sweat, your blood to Infosys. Next day he quit. After that day, uncle has never worked. And recently he passed away after COVID. I mean, not due to COVID, but after the COVID phase, he passed away because of cancer. But he lived his life. He was a very generous man. He did a lot of social service activities. If you get 2 crore worth of stuff and you invest properly 25 years ago, you just imagine how much that 2 crore would have fetched, right? Smart investment, nothing. It was a lot of money that time. Now also it's a lot of money, but think about it. So many years ago, it was a lot of money, right? So that is what it is. So what people used to scam, they used to do this. They used to tell boss, it will be tax. So the taxation also, all that came that time. So they used to do one scam. Bro, you resign today, okay? Tomorrow I'll give you. Why? Because employee stock option plan. I'll name some other thing and give it to you. Only when employer-employee relationship is there, I can give. But the employer-employee relationship is not there. So take it. Point number 1. Point number 2. Reliance Industries, or let's say Tata Consultancy Services, TCS, is giving ESOP to an employee. Rather than giving Tata's consultancy services shares, he will give Tata Motors car shares. Then you cannot come until security is given. Some other company have given, not this. What is sweat equity? Only that company only if you give sweat equity. I'm giving some other security. Tax planning was happening. Finance Ministry did not like it. So obviously you see the perquisite here only. The value of any specified security, deadly. This was added. The value of any specified security. In 2009 Finance Act, they substituted it. Value of any, because 2000 to 2009 people played around like this. Any specified security, which can be anything, by the employer or former employer, was added. Nothing doing. So even if you get 1 year ago you were working in a company, today you get sweat equity for the work done that time, chargeable to tax. ESOP you are getting, chargeable to tax. Specified security means securities as per SCRA. That's all. Anything, guys. Equity shares, preference shares, units, everything is covered. Sweat equity means equity shares issued by a company to its employees at a discount or for consideration other than cash. You see, FMV of the specified security on which the option is exercised as reduced by the amount paid or recovered from him. If it's sweat equity, generally it is nil, or the face value. FMV means the value determined. Now this is what they give. FMV. This is all 17.2. So I told you here, no, FMV. I told you here FMV. How to compute? Summa I wrote 1300. How did I compute that? Now that is there in part as part of rule number 38. Computation of this FMV. Valuation of perquisite. This is purely salary chapter with the rules. So check it out. ESOPs are what? So if you see, one is the, is it a option given or is it mandatory? Employee stock option plan. If I had invested, I was working in a company in 2008 wherein the stock market, the entire subprime mortgage crisis. 2007, they had given me an offer for buying at 500 rupees. 2008 crisis happened. My company tanked. And in 2009, at the time of exercise, market value was 7 rupees. But the exercise price was 500 rupees. Can the company force me to buy the share? No. That's why it's an option. Employee stock option plan. So you see, perquisites are to be taxable in the hands of the employee in the year in which shares are allotted to him under ESOP. I told you allotment year. But perquisite shall be calculated on the basis of FMV of ESOP on the date when employee exercises his option. Taxable perquisite shall be determined as under FMV of the shares on the date on which option is exercised A, amount paid or recovered from the employee in respect of the share B, value of the perquisite taxable when shares are allotted A minus B. Very, very simple. Determination of FMB. This is what, generally you need to just go through. This chart is enough. Where shares in the company are listed on a single recognized stock exchange, FMB will be average of the opening and closing price of shares. Very simple. Opening, closing, average on the date, which date? Exercise of option. But on the date of the option, exercise of option, there was no trading. 15th August, there was no trading. Then closing price of the share on any recognized stock exchange on the date closest to the date of exercise of option. Previous day, immediately preceding such date. If 15th August was a Monday, 14th August was a Sunday, then, Saturdays, Fridays, like that you should see. Where shares in the company are listed on more than one recognized stock exchange, then average of opening and closing price of shares on the date of exercise of option on a recognized stock exchange which has the highest volume of trading. You should see the turnover for those particular shares in which stock exchange it is more. So that I should take average opening and closing. Similarly, if it's not there, previous day. Where shares in the company are not listed on a recognized stock exchange. For example, Google India shares are not listed. In those cases, value on a specified date will be as determined by a merchant banker. Chartered accountant is not there, merchant banker. It is the date of exercise of the option or any day earlier than the date of exercise of the option, not being that it is more than one. So basically, guys, if 15th August is the exercise date, on that day you will see, or you will go back 6 months. Any day he will take. That purely depends on the merchant banker. There are a lot of other things he will do that. That valuation and all is not important for us. That's it. When the employee is selling shares, full value of consideration, sale value, less cost of acquisition will be the FMV of such shares. LTCG or STCG will come. What is the period of holding? Obviously, from the date of allotment will the period of holding start. From this day, it will start obviously. What is the cost of acquisition? Shall be the FMV which has been taken into account for the purpose of section. So for him it is 1300. This is what is taken into account. That is all. That's all I'll have to pay. This is how it is calculated. Right? Very, very simple. Now, there were a few things also. Like for example, if I give a tea box, Tata has, exported tea. So export quality tea. Nobody else will get. Only in the AGM they have declared that, okay, tea I'm giving, tea box. Is it 222A distribution of assets? Is tea box, it's a raw material, it's a finished goods, it's an asset. So guys, no. Why? As per 222A it says, any distribution to all the shareholders. Now tell me, are they giving it to all shareholders? No. Not given to all shareholders. Not given to all shareholders. It's only given to those who actually come for the meeting. If you don't come, you'll not get tea box. And even if the person who is taking 1 share, even if the person who has 1 lakh share, he'll only get 1 tea box. What for 1 lakh fellows, I'll get 1 lakh tea boxes. No. So since it is mentioned that, this is what we need to keep in mind. Very, very simple. And CBDT had also clarified that I told you, this one. This entry. Will you get allowance? No, disallowed as per CBDT. Remember, in ESOP, when I did accounting purpose, you cannot account like that. ESOP expenditure 90 lakh, bank account 10 lakh, to security, share capital 10 lakh, security premium, all that. It's ultimately book entry. Not allowed. Not allowed. This is the correct one. Right? So guys, this is one part of the story. This is one part of the story. What is the second part of the story? What is the second part of the story? Second part of the story is, think about it. You are a startup. Obviously, some Pani Puri shop and all cannot call it as a startup. There should be a proper startup. This startup, let's say, has around 10 employees, and they have given 50 lakh each, ESOP, 5 crore. What was the problem, guys? In a startup, no one cares about the salary. They all look for a stake. All the startups started like that only. What is my stake in the company? Because they have a vision. They know that the company will really do well. And going forward, when the company really does well, I cannot just work on some salary. So you should see an ICAS founder, after the startup became public, crazy money she made. Similarly, Zomato also. Right? Only Paytm, fellow poor guy, it did not make so much money. Then Paytm went for buyback also, all that thing happened. Anyway, so basically 10 employees of 50 lakhs, 5 CR. If I do this ESOP 5 crore and you exercise the option, whatever, first of all, guys, is there TDS on this ESOP, etc.? Yes, TDS outflow, since it's a perquisite. From the company's point of view, TDS will go. From employee's point of view, let's say exercises the option. His salary will be some, let's say, 3 lakhs per month. He exercised the option for 50 lakhs suddenly. What to do, guys? How will he pay? So that's why they requested the government that, sir, for ESOP, please do something. For ESOP, kindly defer the taxation. Kindly defer at a later stage taxation. So how will you defer? If my salary is, let's say, 15 lakh, ESOP is, let's say, 50 lakh. Now, as I told you, overall 65 lakh. Sir, I will pay tax on 15 lakh at the highest rate, 30%. 19.5 lakh I'll pay. No problem. But, sir, the tax on this 50, sorry, tax on overall 65 lakh. Tax on overall 65 lakh is how much? 19.5 lakh it will come. This one, sir, especially 15 lakh you leave, sir, but this part, that 50 lakh extra, kindly defer it. How to defer? One is 140 subsection A, self-assessment tax. So tax on this 50 lakhs is, tax on 50 lakh is 15 lakhs. Overall tax is 19.5. Sir, I will pay 4.5 lakh. Remaining thing, please defer to a later date. What is a later date? We'll see. Second, under section 156, if you do not pay the tax on time, there will be a demand notice in any of the intimations. They amended that law saying that there will be no demand until that date. Which date we will see. Third, in TDS 192 1C was inserted. 192 1C was inserted. Now they say company no need to deduct TDS. You will deduct later when he exercises the option or when he leaves, whatever. We'll see at the later date you do. Immediately only don't do. Then under 191, it's a direct payment, which means if TDS is not deducted by employer, employee has to pay. This also got amended. Even if the company does not do TDS, deduct TDS, you have to deduct TDS at a later date. What is that later date? We'll see. All these things were amended to a future date. What is that future date? We'll see. See the notes. Page 12.2. See, as per section 1726, perquisites includes the value of ESOP allotted or transferred by an employer to the employee. Accordingly, value of such perquisite is taxable in the year when such ESOPs are allotted or transferred to the SSE employee. This leads to cash flow problems for the employee who does not sell the shares immediately and continues to hold the same for long term. Startups generally use ESOP to attract and retain highly talented employees as the startup has liquidity crunch. To incentivize the startup ecosystem, Finance Act 2020 has deferred the tax liability of the startup employer 192(1)(c) and also the tax liability of the employee 140(a). Within, this is important, 14 days from the specified date. 14 days from the specified date. What is specified date? Expiry of 48 months or 4 years. That is from the end of the relevant assessment year. That is year in which the ESOPs are allotted or transferred. Allotted or transferred. So for example, if it was allotted on 30th March 2022, what is the relevant assessment year? 23-24. From the end of 22-23. The end of 23, 4 years. So guys, apart from 48 months, I will get these 12 months also. So roughly I'll get 60 months. So basically, actually I'll get 5 years. Assessment year is 1 year plus 4 years. 5 years, deferred by 5 years. Because that is the time when I'll know whether the company will really do well or go down. In ESOP valuation, everything will go for a toss anyway at the time of exercising. Or whichever is the earliest, obviously. Or ESOPs are allotted or transferred. This is vesting period if it's so long. What if it's allotted now only? Or if it is sold, then obviously you have to pay, no? You cannot transfer the ESOP to the shareholder and then he will coolly wait. No. 14 days from the day ESOPs are allotted or transferred. Third, date of sale of such ESOPs by the employee. Generally there will be a, time period. By this you should not sell. If you sells before that, yes. Date on which the SSE ceases to be an employee, yes, I will leave my job. If I leave, yes, that date, whichever is earliest. Note 1, the employer shall be eligible startup in accordance with ATIAC. We have seen this that time. There is no change in the value of perquisite in the year of chargeability. That is, the perquisite continues to be chargeable in the year of accrual allotment. Only payment of tax is deferred. Chargeability will continue, payment is deferred, that's all. The effects are as under. Value of perquisite on ESOP shall be included in the income of the employee in the previous year in which the ESOP is allotted. If ESOP is allotted in 28-1-23, perquisite on ESOP shall be included in the income of the employee previous year 22-23, that is assessment year 22-23. However, as per the amendment in section 140A, self-assessment tax shall be reduced by the tax on perquisite, besides other reduction. Therefore, employee is not required to pay tax along with the return and he shall not be treated as assessee in default. Though he has to offer to tax that year, the payment will be deferred. The employer shall deduct TDS on ESOP within 14 days from the specified date, as per the newly inserted section. As per 192(1)(c) Inserted Finance Act, if employer is not able to deduct tax within 14 days, employee shall pay the tax on his own within 14 days from the specified days. This was 191, direct tax scheme. As per 156(1), AO shall issue a notice of demand specifying the sum payable on which value of perquisite disclosed in ROI for the year in which ESOPs are allotted or transferred. Such sum would have generally been payable within 30 days. And SSC would have been read as SSC in default. That's why one more clause was inserted in 156.2. A protection to SSC. The employee shall not be deemed as SSC in default on receipt of notice in demand. However, provisions of deeming the employee SSC in default shall become applicable only if you do not make it within 14 days from the specified date. 14 days from the specified date. 14 days of what? Specified date. So let's solve a problem, guys, so that it will be very easy for you. It is there in my compiler also, separate questions, but you solve this now. We'll write it together and solve. Mr. Ambi was an employee of Master Limited, eligible startup, gross salary 26,50,000, December 2019, granted options to apply for 20,000 shares at 20 each. All options were exercised. By Mr. Ambi on 1st March 2020. FMB was 200 each. So guys, exercise FMB only you should take. So this is an important FMB. Shares were allotted. This becomes cost of acquisition, remember. Shares were allotted on 20th July 2020 when the FMB was 230 per share. This is irrelevant, but this date is important for period of holding. Now out of this 20,000 shares, $10,000 shares were sold through recognized stock exchange on 5th August 2023 at 500 rupees each. Second, 10,000 shares were sold on recognized stock exchange, 700 rupees on May 15th, 2027. He resigns from the post on 31st March 2028. What are the tax consequences? What are the tax consequences? So check it out. First of all, what is the gross salary? 26,50,000. Value of perquisites, how much? 20,000 shares is getting. What is the FMB, guys? What valuation? You have to do 200 rupees minus this one. That is the perquisite face value. That is what they are allotting him, right? 200 is giving at 20 rupees. This is the value of perquisite, 36 lakhs. So less standard deduction. See, this is an income from salary question, 50K. Overall is how much? 62 lakh. Tax on this entire thing. Normal provisions, if you do tax, 19 lakh, 13,340 will come. Overall tax, this will come. So I need to figure out what part of it is to be deferred. See, I told you that time 30%, thinking everything is over above slab rate. Here I have to take the slab rate also. Now I have to compute average rate of tax. Average rate of tax. How much is it? 19 lakh 13,340 divided by 62 lakh into 100. 30.86%. So tax to be deferred under section 192 1C. 30.86% of 36 lakh. 11 lakh 10,960 is to be deferred. Average tax I should calculate. Actual calculation is like this. So what is the tax to be deducted? As per 192, it is 8,02,380 rupees. So assuming the company deducts all this, his advance tax, etc. properly, self-assessment tax will be nil. I mean, TDS only if they deduct, advance tax also will not come, self-assessment tax also will not come, nil. Now, 10,000 shares sold on 5th August 2023. Now, as per the section 192 1C, TDS liability will come earliest of the three. First one, when was the thing given? Year, this one. So what is the financial year? 31st March 21. What is the assessment year? 31st March 22. This comes under the assessment year 21-22. Simple. It comes under the assessment year 21-22. So assessment year 21-22 plus 48 months plus 14 days. That is 31st March 22 plus 48 months plus 14 days. 23, 24, 25, 26, 31st March 26 plus 14. So April 14th, 2026. Point number one. Point number two. 14 days from the day he exercises the offer. Sorry, 14 days from the day he sells or makes the transfer. That is which day? Talking about 5th August, you know. August plus 14 days, 5th August 23. 19th August 2023. Third one. 14 days from the day he leaves the job. When does he leave the job? 31/3/28. 31/3/28 plus 14 days. 14th April 2028. So what is earliest of the three? August 2023. So on 19th August, this only no, 19th August 2023 will be taken into account. So on 19th August, you have to obviously deduct TDS proportionately. What was the entire amount to be deducted, guys? Tax to be deferred 1110,960. 1110,960 was actually for 20,000 shares. So it should be divided 10,000 shares out of 20,000 shares is being sold. So 5,55,480 has to be deducted. If this is not deducted, deemed to be in default. Deemed to be in default. Capital gains will be what? Sale proceeds. Sold it for what amount? 500 rupees, right? 500 rupees. 500 rupees into 10,000, 50 lakh. Cost of acquisition. As I told you, 10,000 shares into FMV as on the date of exercising the option, 200 rupees, 20 lakh. Long-term capital gain, 30 lakh. Tax on capital gain you can compute. Remaining, when should he, one is this 19th August. Next, that is done, 19th August 23. Then what should he do? The balance 10,000 which he has, that should be done same. If you see 15/5/27, that is the day he gives plus 14 days, or resigns. Come back. 14th April 28 or 14th April 26. Correct? 19th August is when he sold. You leave that. Next time when he sold 27. So 14 days, the 27, that will not come. 14th April 28 will not come. What will come? 14th April 26. So on 14th April 26, he has to, company has to deduct the remaining 5,55,480. Otherwise gone. Otherwise gone. That's it. When you sell it, whenever it is, when you sell, how much did you sell it for? 700 rupees, 70 lakh. Minus what is the cost? 10,000 into 200, 20 lakh, 50 lakh. Capital gain on May, capital gain in May 2027 will be 70 lakh because 10,000 into 70 minus cost of acquisition is 10,000 into 200, 20 lakh, 50 lakh. That is separate. This is how we need to see. If at all they ask the question, it will come like this. This was an examination question. That's all about taxation on ESOP and startup taxation. So in the next class, we'll start off with very, very important concept of trusts. Trusts. Charitable trust, religious trust, next class. Take care, guys.